Welcome back, Arts Fundraisers. In this session of Creative Capital, we'll discuss how to plan your year of annual giving. Fundraising is a marathon, it's not a sprint, especially when it comes to annual giving, which is often more like Groundhog Day. But in any regard, success comes from fundamentals and not from luck. What are those fundamentals? For our purposes today, they are planning ahead, setting clear goals, and tracking your progress as being keys to success. Let's get a little more into it though. Number one, your goals are what drive your program. Having the right formula to set those goals is critical. We're going to walk through that, how to set those goals in just a few minutes. Number two, you need to develop an action plan to support the pursuit of goals. A goal without a plan is just a dream, and a vague plan is a nightmare. Number three, a plan without a timeline never comes to life. It never gets momentum. So create a timeline that drives activity forward. Let me show you how we think about preparing the basic structure. Our basic structure is that goals and plans and timelines aren't developed independently in a vacuum. At RSC, we believe that goals and plans and timelines should be intentionally and firmly linked to ensure success. Seems like common sense, I understand, but too often we see arts organizations that develop a plan, then they attach goals to it, and then they might put a timeline. And we believe that plans are living, breathing documents that need quarterly review and adjustment. We view these as the core building blocks that create the foundation for year-over-year growth. I almost never see a goal get smaller from one year to the next. So if we talk about year-over-year growth, you'll understand. Let's put really clear definitions on these. And the first one is just about the goal. The goal is, where are you going? What are you trying to achieve? The timeline is the pacing of how you'll get there. Remember, in earlier videos, we talk about 65% of goals should be reached in the first 6 months of the fiscal year. And your plan are the specific tactics within that timeline. They are the actions you take to get the results. Together, these three drive the momentum and productivity of your annual fund for the entire year. As I said earlier, you do make adjustments throughout the year, so think about this as a breathable kind of document. We'll walk through what that process looks like. We'll look at it in some more detail. Again, for these videos, we'll keep our conversation focused on annual giving because it'll make the most sense. We're going to start with the goals because you have to know what you want the end result to be. I'm showing you a very common best practice approach to goal setting. It's not just 1 but 3 years so that you can begin to create plans and timelines that drive you to fiscal year 3. It's good to have that much vision so that you're not always on your heels at the beginning of each fiscal year or during budgeting time to try to figure out exactly how much you're going to raise. A 3-year arc helps drive repeat tactics, and it helps you set up a really reliable timeline as well. On this, though, you'll see keeping the revenue categories general, but they're pretty distinct. We have board gifts, we have other individuals, then we have business or corporate, foundations, and then government grants. I haven't put things in here like special events and that sort of thing. For the purpose of our conversation, I think this will work. You have to know what you're aiming for, and that's per category. But listen, if you calculate goals strictly on the need, you're going to set your program up for big disappointments. Almost every arts organization has done this. I get it. We back into the number for fundraising. I understand why. You probably do too. It's just not a very good way to do it. At RSC, we help clients set goals by reviewing historical changes in their dollars, in their number of donors, and in their gift averages. And we do this to each one of those giving categories that you see on the screen. This slide represents a summarized view of that information. You'll want to go deeper and include giving levels within each category that are particular and specific for you. But big or small, how do you actually calculate a goal? What is the math that takes you to calculating that goal? I'm going to walk you through that right now. It's very simple, it's very reliable, and it's a great, great starting point. First off, how much money do you need to raise? And then second, how do you calculate that for your annual fund? Knowing your numbers, and always take attrition into account. This is a spot where a lot of organizations forget and they miss. But let's just look at it this way. Let's say it's March and your fiscal year starts in July. And it's budgeting time in March, and you have to create goals for your annual fund campaign. And to do that, the first thing we have to do, since the fiscal year isn't over, we have to project what we think the current fiscal year final is going to be. And that's in every one of those categories that we just looked at. I hope you're doing that already, but if you're not doing it, you should do it. And the byproduct is you can use that for an exercise like this. The next thing you do is take out historical attrition. I usually say 3 to 5 years. You need to know per category how much money do you not renew year over year on average in each one of those single categories. You need to get a good feel for it. Corporate may be different than individual, and broad-based individual might be different than board individual. And so that's why I recommend doing it for every single one of those categories. You take your projected current fiscal year final, you minus the historical attrition, then you add, we finally get to add, we add what we think is quantifiable gross growth. At the broad base of individual giving, you might have to use calculations to do that, raw numbers. At the higher end of individuals, you could do it donor by donor. If you look and see how many donors do we think we can increase from 1,000 to 1,500 or from 2,500 to 5,000, and you do that person by person, you can really start to visualize and justify what quantifiable gross growth looks like. The way that you can do it, again, is by looking at those historical numbers and then overlaying that with specific information that you know about specific donors at the higher level. Or if you're using a formula at the broad base, utilizing that formula to get quantifiable gross growth expectations. And that's it. That's your new fiscal year goal for that division or for the overall annual fund, depending on where you are in the exercise. It is simple. Projected fiscal year final minus historical attrition plus quantifiable, justifiable gross growth. That gives you a new goal. All right, so now we're going to talk about the action plan and the second part of that graph that we looked at earlier. Now that you can calculate the goal, let's talk about what goes into the plan itself. I think the successful annual fundraising program is actually built on a multi-year plan. Yes, I know that can be difficult sometimes, but it's a tactical plan. It's preferably one that aligns with an ambitious strategic plan that the organization has. If you don't have a strategic plan and there's one coming up, try to align fundraising goals with that plan. There is one in place. Certainly adapt your goals to that as well. I say 3 years max because I don't think anybody has a crystal ball beyond that. Most organizations don't create strategic plans that are longer than 3 years, and there's just too many what ifs and volatilities and unknowns to try to take it beyond 3 years. You could do this every year and add another year on so that it's always a 3-year plan. You do need time to establish and grow relationships. You need time to build trust and to meet your fundraising goals based on a predictable path. Start by identifying those aspirational revenue goals that we talked about and then breaking them down into those very specific targets of activity. These should include a mix of major gifts and individual donors, your board giving, your institutional giving, but keep the plan simple and flexible. And I'm going to show you an example of that in just a minute. We talk a lot about front loading, get that 65% of activity done, of the goal achieved within the first 6 months of the fiscal year. Your plan and timeline need to reflect that. You're going to be very, very busy talking with your very best donors and prospects in that first 6 months so that you're at 65% of goal by mid-year. I say this often, but the days of an annual fund are not equal. The early days of a fiscal year are much more valuable to an annual fund than the back days. And so front-loading approach will build momentum, and it will allow you time in the latter half of the year to cultivate those new relationships, that new money, some of that increased money that we talked about. Get those early wins. You need the confidence in those early wins so that you don't go into the second half of the fiscal year feeling the pressure and the need to achieve that goal because you're so far behind. Get that work done so that you have the time to grow relationships, make some mistakes, have some disappointments, but still reach goal. Let me just talk about that 65%, whatever it looks like. For example, if your goal is $1 million, you need to aim to raise $650,000 of it in the first 6 months of your fiscal year. And I know if you're not doing that right now, that sounds like a tremendous turn, and it is. But always remember, it doesn't necessarily have to mean that the money is in the bank. The question we get is, can that also consist of pledges? Yes, it can consist of pledges, particularly from your major donors. So if you have a donor who gives $10,000, they always give it at the end of the fiscal year because they've been trained or you've been trained or whatever. Somebody's been trained that's when they do it. You could still ask them earlier in the fiscal year, but make it payable when they're comfortable making the payment. So I want to dispel that. We have the fortunate ability to take pledges and send reminders, and so don't ignore that ability. All right, but let's talk a little bit more about what that timeline includes. It will include a target segment, solicitation approach by month, cultivation and stewardship opportunities built in, and solicitor notes, and other things that might be going on that help with the timeline and the tactics and the approach and so forth. Let's take a look at what one of those looks like in a very, very simplistic form. This is where we usually start. And you might ask yourself, is this a plan? It is a plan. This is a starting point to a plan. At least the beginnings to get everything on paper so that you can see the landscape. As I said, it'll be enough to inform and help design more narrative, which I really do encourage that you write a plan. I don't view plans as a straitjacket. It shouldn't be 50 pages thick because you'll never look at it, but it should be more than this. Let's get started with this part though. I pulled out $1,000 plus. We take what I believe is an 18-month snapshot here. We look at just the tail end of last year. This is what this year will look like. And then, of course, we have what next year, which is going to be somewhat repeatable, but may not always be precisely repeatable. And so we have our targets. Who are our targets? We have lapsed donors in there. We have identified acquisition targets. And of course, we're going to talk to unrenewed people. And then you can see month over month what that looks like in terms of who do we talk to about providing support to our arts organization. The next one, the pink one, is solicitation approach. Is it a phone call? Is it a personal meeting? Is it a follow-up letter after a personal meeting? And so you begin to populate that with the ideas of how do we talk to each person in that group. The third one, the cultivation and stewardship, those are events that you might have, but they're also one-on-one. You might take an entire week where you just thank donors. You call them and you thank them, even if you've already thanked them. So it might be an event, it might be a moment, it might be information, but there's cultivation and stewardship that happens. And then there are solicitation notes about things like when the development committee meets so that we can help arrange some of the activities that we have, what kind of support that we're going to offer, anything else that's coming around the bend. Sometimes I'll put in there organizational events to make sure that we are well coordinated with them. But again, always front load those best segments first. You can see it in here. And as you can see, I've combined those action steps in the timeline in this example. One of the things I would encourage is that you start with this because it combines timeline and activity. It's a very nice 30,000 foot way to start. Then you'll take that information, like I said earlier, you'll put it into a more detailed plan that will include timeline and will include activity, but they'll probably be a little bit more separated out than this so that you can provide yourself with more detail. Next, you have to track results. And I often say if you can't measure it, you can't manage it. So if we can't measure it, how do we make any changes to our plan? How do we get better? How do we create efficiencies? I didn't invent that saying, obviously, but I certainly own it and I certainly believe in it. At RSC, we encourage clients to review results in a variety of ways. It's not just about dollars. I'll say it a third time, it's not just about dollars. Looking at the revenue, of course, is important. You have to do that. But it can be deceiving, particularly if you're front-loading the campaign as we're talking about. You might get out of the gate really well and get all your renewing donors over $25,000 to commit right away, which would make you very, very comfortable. But if you don't have very many donors to show for, let's say the broad base didn't respond in the same way, you've got problems. And if you're just looking at the dollars, you don't know that. We compare dollars and donors and gift averages in a very, very specific way. And let me just point out then a few. You can see on this chart, we have this fiscal year to date. You might have an actual year attached to it. And you'll have last fiscal year to date to the right of it. So those are the two big blocks of area. And to the extreme right, we do a metric there where you can see ahead or behind in terms of dollar and percentage. Why dollars and percentage? Because goals almost always increase. And when those goals increase, if we're just measuring dollars, then it may look like we're always behind, but the pace you're setting can be very important as well. So let's just run through each one of those columns. On the extreme left, we have the directors and trustees, we have major gift individuals, we have broad-based individuals. Then you have your institutional giving. We've covered all this in earlier videos about how that might break out. Yours may look just like this, or it might be slightly different, and that's okay. Then we have project support, which might include, down towards the bottom, which is special events. So when you see that sort of turquoise where it says this fiscal year and then it says project support, we actually break that out from the annual fund because those things are activities that may not recur. And if you remember, our annual fund, we want it to be recurring revenue that we can count on year over year that doesn't have a lot of volatility associated with it. And so you can see that blue line midway where it says total annual fund. Since it's not the only fundraising we're doing, put the other activities below that line, and that way we can continue to measure it. We like to track since the last report. Sometimes you'll create a report weekly, sometimes it'll be monthly, sometimes it'll be every other week. It doesn't matter, but since the last report, to make sure that we're not losing momentum. That's designed so that we know we're not losing momentum. We put the number of donors as the next column. It's important to know how many people or institutions we're talking about are representative here today of that gift line. The next column is year-to-date revenue total. You can see we've just populated this with standard numbers, but you could see what that would look like. It doesn't meet the 30-70 percentages that I talked about earlier, but I wanted you to see what it would look like populated. So that year-to-date total, and we track that. That's everything that started since the first day of the fiscal year. And then we look at percentage of goal just to the right of that. It's important to know, based on our goal, which is the next column over, how are we doing in terms of a percentage? Continuing to move over, now we're looking at last fiscal year. We're looking at the number of donors there. I can do a very quick eyeball check and say, well, this year we have 5, last year we had 4 when it comes to trustee gifts. And then I can look at the year-to-date dollar amount, and it's $9,000. This time last year, it was 20.3% of its final, which was $44,444 in this example. We were at 20%, just a little over 20%. This year, we're at 39.6%. You can see that sort of in the middle of the page again, middle column of the page. And then to the far right again, you can say, oh, great, we're $13,000 ahead, and we're 19 percentage points ahead in terms of revenue. So we track the revenue on this. We also track the gift average in a similar way and the number of donors, but I didn't want to clutter this up. So we're just looking at the revenue. I would encourage you to do the same sort of year-over-year comparison in number of donors and gift average as well. One thing about gift average, don't expect the gift average to go up all the time. If you're doing a really good job, a really expert job of acquiring new donors, part of the success is you're probably bringing them in at a lower gift average than your renewers. And so it's going to drive the average down. It'll drive the gift average for that division down. And that's okay. If you're winning in terms of dollars and you're winning in terms of number of donors and the gift average is coming down a little bit, I'm okay with that because your job will then be to preserve those new donors and increase them eventually to bring that gift average back up. That's a very quick snapshot of how we look at numbers because it helps us drive those quarterly decision changes. Is the plan working? Do we need to do something differently? Is there an opportunity? What are your next steps? Consider these following adjustments. First of all, front load your efforts. Identify those opportunities to accelerate fundraising activities in the first half of the fiscal year to build momentum. We talk a lot about momentum. Once you have it, it's great. You can keep things driving forward. But if you lose it, it's really hard to get back. So that's why we say front load those efforts, build momentum quickly. Number 2 is to diversify your resources. Do you have the staff, the volunteers, the artists? Do you have all those helping hands and feet that we talked about in an earlier video involved in attracting and retaining donors? Are you using the resources that you have? Does everyone understand and accept their role in this? And do they know the plan to help make that annual fund grow? Number 3, implement success tracking tools. If you're not tracking your results or if you're tracking them only with dollars, dedicate yourself to get a little more sophisticated. Utilize those tools, utilize your reports, and monitor, not just for you, but also communicate the progress to all those people who are helping. Everybody should know, how are you doing on the annual fund? And is it paying off? Are the actions paying off? Are you getting the results that you want? With a solid plan, clear goals, and a timeline that promotes early momentum, you really can set your organization up for long-term success year over year and continue to hit goals.